Hello everyone, my name is Akash Mitra from Core Finance 2. So today my topic is about group versus individual lending in microfinance. So let us begin without wasting any further time. So now let's understand what is microfinance. To start with, let's look at what microfinance actually does. So it is the heart of microfinance institution. At its heart, it is the microfinance institutions or MFIS extend vital financial services, mainly credit to low-income individuals who have excluded from traditional banking. Basically, two primary lending models. Because of borrowers come from different backgrounds, MFIS generally rely on two distinct models to manage risk and support growth. The two primary models are, the first one is group lending. So like in this model we can see the model is like built on collective responsibility. Essentially borrowers from a small group, and they look out for one another to ensure the loan is repaid. And the another one is individual lending. This lending focuses mainly on personal accountability, where the financial relationship is directly between the institution and the individual borrower. So these are the two types of lending. So now let's dive into the focus on the first model, which is group lending. So this in this model we are not just focusing on or looking at one person. We are looking at a collective of 5 to 10 people or members. Instead of bank dealings with one individual, the loan is issued to an entire group, and every single person in that group is jointly responsible for making sure the total amount is paid back. It's a system built entirely on mutual trust and peer accountability. So now let's see how it works without collateral. Now let's break down these three pillars that make this system work even when people don't have a lot of money or assets. So first we have is social collateral. In traditional banking, if you want a loan, you have to put something up, something like a house or a car, anything like as a collateral. You have to provide it to the bank, right? That's how you get loans in bank. But in this group lending, we can replace that uh, with social collateral. This means peer trust and group pressure act as security mechanism over here. So basically the borrower's reputation within their community is what guarantees the loan. Next we have is shared risk. So this is where the strength in numbers really shows up. If single one of the members of the group defaults or can't pay, the entire group is collectively liable. This creates massive incentive for members to support each other. They basically act as each other's coaches to make sure everyone succeeds and pays back the loan or pays back their share. So next we have the third one is rural reach. Because of this model relies so heavily on communities, ties and people knowing each other, it is incredibly popular in rural and unserved communities. The main factors we can say that define how this model works. So first is borrower's assessment. Since the risk isn't shared, the MFI performs a rigorous upfront evaluation. They look closely at the person's repayment capacity, the stability of their income, and whether their business idea is actually viable or not. So next we have is larger loan amounts. This model generally is better suited for established businesses or people with steady income who have outgrown small group loans and need more capital to reach the next level. Collateral may apply like unlike group lending, which uses social collateral. This model may require more than formal security. This could include like proof of income, documentation of assets, or detailed cash flow statements to secure the loan. In summary, to summarize this, we can say essentially if group lending is about getting people started through community support, individual lending is all about helping proven entrepreneurs scale up through a formal, tailored banking relationship. So now let's focus on this chart. We have the head-to-head comparison. So let's look at this table. This table basically highlights why institution might choose one over the other depending on the borrower's needs. So these are the two models basically. So the key differences at a glance I can say is, first we have the point is risk bearing. So in group lending the risk is shared across all members. For individual lending the borrower carries that weight entirely on their own. The loan size typically is you can say, next is loan size. The loan size typically see smaller amounts in groups, while individual loans tend to be larger or scaling business. Next we have is collateral. Group lending uses social collateral or peer pressure, where individual lending the individual loans often require formal proof of income or assets, as I mentioned in the previous slide. So next we have is monitoring. In group lending, members monitor each other. For individual lending, the MFIs performs direct follow-up and evaluations. Next is the stress levels. So interestingly, the stress levels is often higher in groups. Because of that, the shared accountability to your peers. For individual lending, we can say the stress is kind of lower because it's personal. Next we have is MFI cost. Groups are cheaper for institution to manage because they can access many borrowers at once. Next we have individual lending. In individual lending, these costs are eventually higher because every person requires a separate detailed assessment. In the group model, the biggest advantage here is that it requires no collateral, making it truly accessible to the very poorest, I can say, individuals. For the institution side, it's great because the risk is distributed. So the MFIs isn't just relying on one person, and the operational costs are much lower per borrower. So however, there are trade-offs that same collateral, social collateral we talked about can lead to higher peer pressure, which causes social friction and stress. Also, if the group starts fighting, that conflict can disrupt and the entire repayment cycle, and it can disrupt the entire repayment cycle basically. So in individual lending, there is growth and independence, I would say. On this individual lending, the major pro is the larger loans enables meaningful business growth for established entrepreneurs. Plus, the borrower retains full autonomy. They don't have to manage any complicated group dynamics or worry about anyone else's mistake. The trade-off for MFIs in higher risk and operational costs, because they have accesses to everyone separately, and the borrower, it's simple less accessible if they don't have the proper documentation or income proof to back up the loan. So here we are at the final slide, the conclusion to bring everything together. So first we have is group lending, which remains the ideal entry for low income individuals who need small startup loans but lack any form of collateral. So second we have seen is the individual lending is the very natural next step for established borrowers or entrepreneurs who have proven their reliability and now need larger independent credit to scale up their businesses. So next we have is the ultimate goal in financial inclusion. By using both these models, we can expand economic participation and support long-term development for those who were once completely excluded from the financial world. So I think that concludes my presentation for today. I hope this gave you a clear picture understanding how microfinance work to empower communities from ground up, whether it's through strength or of a group or growth of an individual. The mission remains the same, the, as I have explained. So creating opportunity where there was none actually. So yeah, so thank you everyone for your time and watching this video. So let's end this over here. Thank you so much for watching.